About market cycles, do you think there's something different in these last years that the cycles have become much shorter and the reactions have become much faster in terms of the market correcting, especially on the way down? What has changed compared to even past crises that were much longer and much more difficult to correct? And
Okay.
secondly,
Oh.
if you had to pick one area to take a big risk, which area would you take a big risk in the market?
As to the speed of fluctuations, on the one hand, one of the biggest changes that's taken place in the investment world since I joined is investors' timeframes. Because when I started, we used to think about it. I started at Citibank in the investment research department. We used to think about investments as lasting 6 years. Now, very few last 6 months. And everybody's trading, and everybody cares about what was your return last quarter and what are you going to make next quarter. And these things really don't matter. An excessive concern with the short term is really a way to go wrong. And ignoring the short term, in my opinion, is really a way to get an advantage over other investors. But the fact of the matter is that everybody's looking at short-term performance. If you go back, let's say 50 years, before computers were widespread and so forth, you would run I was at Citibank, where you'd run a portfolio, and the year would end, and 3, 4, 5 days later, you would find out what the rate of return was that year. They had to do a bunch of calculations by hand. Today, you can look at your Bloomberg machine on your desk in your office, and you know your rate of return to this minute in real time. And this, given human nature, this encourages short-termism. If you know that you're up 4.6% this month and everybody else is up 4.8%, you freak out and you engage in all this trading to try to get better. So I think that is it causes quicker reaction times. And of course, we might as well jump on the bandwagon and blame social media, which is responsible for everything else bad in society. But you watch the shows on TV, and you get somebody on, he says you should buy, and so people buy, and then the next guest says you should sell, and things go like this. But on the other hand, when you make an observation like the fact that things are fluctuating more, you have to realize that we make generalizations in life by looking at a large sample. If you said to me, what's the height of the average person in Sag Harbor, and I based it on the height of the next person to come through the door, that would be a mistake. You need a big sample to make generalizations. And when we make generalizations like the reaction time is shorter, we have a small sample. We've only had 2 crises so far this year, this century. The century is a quarter old. We've had 2 crises. So generalizing about what is true from a sample of 2 in 25 years is a weak proposition. Now, what to invest in? I'm not good at that, and I hate to do it because I would be terrified that I would say something and you would buy it, because I won't buy it. But in general, I'll just say that if you think about this is helpful, I think, in investing life. You think about 2 piles of assets. And on this pile of assets are the things that everybody knows about, feels they understand, feels good about, or optimistic about, find respectable, and find positive. And then on this pile, you have the things that people may not understand fully or don't think they understand, find a little bit disreputable or tacky or risky or scary, or they're pessimistic about. Okay, where are the bargains? Second pile. So in general, it's a bad idea to buy the things that everybody loves, and it's a good idea to buy the things that everybody hates. Or I should say, you wouldn't buy everything on this pile, but you would look in this pile. And that's what I've done all my life, and that's how you find bargains.
I'm going to be a little controversial, I don't want to touch this stuff, although it's becoming seemingly more attractive, is, of course, Bitcoin and gold. Okay, Bitcoin is very volatile, but every low is higher. It's always higher. And also, as a protection against the value of the currency. So I just wanted to bring that up because,
Well, I mean, this is one of the top 5 questions these days, and has been for I think 2017 is the year that Bitcoin exploded into people's consciousness. So for the last 8 years, people have been asked about Bitcoin, and I wrote a memo in 2010 called "All That Glitters," which I talked about what I know about gold, and I apply a lot of the same reasoning to Bitcoin. In my opinion, in the investment world, there are 2 kinds of assets. There are assets that produce cash flow. What are they? Stocks, bonds, companies, buildings, all produce cash flow. And if you see a building or a company or a bond that throws off $1 million a year in cash flow, you can put a value on it. Some people would buy it for $9 million. Some people would stretch and buy it for $11 million or $12 million. But you can talk about what's the fair value. Then there are a bunch of assets in the world that don't throw off cash flow. Diamonds, furs, paintings, a barrel of oil, gold, and Bitcoin. They don't throw off cash flow. And if something doesn't throw off cash flow, you can't say what the fair value is. And look at Bitcoin. You can say you think it's going up. Somebody else may think it's going down. But you can't tell me what the fair value of a Bitcoin is. And just the same as gold, by the way, which means to me that you can't invest in Bitcoin or gold or diamonds or paintings analytically. You can, because what is the price on those assets? It's what the market will bear. It's what the seller will pay. But you can't justify it analytically. So if you read the memo, All That Glitters from 2010 about gold, I conclude that you can buy it if you want because you think it's going up. You can buy it as a superstition. You can buy it the way many people do because they're afraid that if they don't buy it, it's going to go up and they'll kill themselves. FOMO. But you can't buy it analytically. And I think, I happen to think that the same applies to Bitcoin. Just me.
On your April 12th, I think, memo, maybe it was April 13th, you talk about DEF CON, and you talk about sort of overvaluation. Do you have a view on what asset classes or, are bubblicious? I mean, is AI, going to continue, or do you think that the valuations are just absurd?
AI. Yeah. Okay. Well, okay. Whenever there is a surfeit of enthusiasm for an asset class, it is usually where there's something new. It's the new thing, because it's very easy for excitement to coalesce around the new thing. First of all, it's never been seen before, so the restraints, the limitations aren't obvious. Secondly, there's no history, so you can't say, well, this has always happened in this industry or something like this. And whether it's the nifty 50 that Xerox, IBM, Kodak, and Polaroid that were flying high when I joined the business in '69, or disk drives in the '80s, or internet in '99, or maybe AI today, the limitations are unimagined and the imperfections have not come to light. So the excesses in the markets usually occur around the new thing. And certainly AI is the new thing. And, certainly AI will change the world. And I think that the world in 5 years will be unrecognizable from what it is today, in good ways and bad. And so, AI stocks are on fire, and NVIDIA and so forth. Back in '99, the mantra was that the internet will change the world. And as a consequence, people said, thus, there is no price too high for an internet stock. And guess what? The internet changed the world. Can you imagine the world today without the internet? And yet, I imagine that 99% of the internet stocks that came out are worthless today. So the progress of the new thing is not the same as commercial success for the companies that participate, and because so much is on the come with regard to an exciting future, it's very hard to have discipline as to value. And there are 2 other phenomena that I'll just touch on and then run out of here. One of them is that we get what we call a lottery ticket approach. And you say, well, if I buy it, it may only have a 2% chance of staying in business, but if it stays in business, I'll make 1 million times my money. So I got to do it. But what you're saying is 99% of the time you threw your money away. So it's the intoxication of the upside that forces people to action. And the other thing is when you have a bubble surrounding a new thing, people assume basically that the companies that are today's leaders will be tomorrow's leaders, which is always in doubt, and many of the other companies will succeed too. And usually those assumptions are shaky. So you can only invest in the new thing with trepidation.